Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Julian Emanuel of Evercore setting a 77.50 price target for the S&P by year-end, expecting more of everything that drove 25, more AI, more stimulus, more earnings growth, more volatility. Julian joins us now for more. Julian, good morning.
Good morning.
Good to see you, sir. Welcome to the program. Everything that worked last year is going to keep on working. The temptation to choose something new, find that new thing. Why aren't you embracing it?
So the issue here is, and again, this concept of concentration risk. If you go back to the beginning of this century, when the top 10 stocks were 25% of the weight in the S&P 500, there was a thought that could not be exceeded. We're now at 40%. And frankly, again, if you think about concentration risk, you look at a market like Korea, where in the Kospi, you've got two stocks that account for 45%. So the point is, the math doesn't work for these stocks not to market perform or outperform. But the truth is that the capital market cycle has yet to fully play out. And the beneficiary of a robust capital market cycle, time and time again, are the stocks that led you into the cycle.
So for anyone that comes on a program later on this morning saying dive into what's happening in Asia, what's developing in South Korea, you're saying take a step back, resist?
No, we're basically what we're saying is that, there should be a discomfort around the fact that the market is really clustering in this theme, but that discomfort, as we saw earlier at the end of last year, with the discomfort around the one marquee name that has taken on a great deal of debt to finance CapEx, the majority of these companies have, very, very robust cash flow. And so therefore, you're going to have this sort of virtuous cycle of earnings continue to be driven by these names.
Is the bet right now just to bet on the biggest tech companies in both regions, both the U.S. and China, betting that they can consolidate their dominance going forward, regardless of whether the U.S. or China wins? It
does come down to that to a great degree. And we get asked all the time, again, should we rotate to other sectors? We think there'll be plenty of opportunity to do it opportunistically. There's going to be a continued skirmish around healthcare towards the end of this month, obviously. In fact, with the one big beautiful bill, tax benefits starting to kick in later this quarter, we think there's an opportunity for consumers, beaten down consumer names to rally. But you step away, and the bull market has been led by these names and these themes, and we think it just has further to run.
There might be some people who read what's going on in the news and then look at markets and say that everybody's just going, la, 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 la. We're not going to listen to anything that could potentially be game-changing. Is it just bet on what you know, and that when you don't know so much, you just ignore it?
Well, I think, again, part of the rationale around AI is you're still betting on something that you don't fully know. Okay, and for us, what we think is going to happen in 2026 is you're going to go from the inflection year, 2025 for AI adoption, to the year where it accelerates when corporate, global corporates realize that if they don't find ways to drive revenues and cut costs through using AI, they will be at a competitive disadvantage.
When Lisa says things going on in the news, she means Venezuela. And you actually write in your note that you think, if anything, Venezuela increases the chances of an AI bubble. Why is that?
So think about a confluence of events. First of all, we found out a week and a half ago that the economy's last reading was actually stronger than expected. Thinking about the stimulus stimulus that's ahead. It sets up more economic upside in the U.S. In fact, our team just took its 2026 forecast up to 2.5%. From a Fed perspective, we actually think there won't be 2 cuts. There'll be 3, possibly more.
How do you have both? Growing economy, fiscal stimulus, potentially higher inflation, and then you're saying 3 Federal Reserve cuts?
Because you have a political backdrop where the impetus is to keep the consumer moving forward as we get to the midterm elections. Now, on Venezuela, basically the issue here is long-term, it's likely a moderating influence for oil prices. And if you think about oil prices staying, flat for longer, that's bullish for long-dated bonds.
Let's park Venezuela just for a moment. Your view on the Federal Reserve becoming increasingly politicized. In the last 24 hours, we've had a series of guests come on the program and talked about the unintended consequences of pushing for lower interest rates at the Federal Reserve, galvanizing the other members of the committee to push back against the push for lower interest rates. Why are you taking the other side of that?
Essentially because a couple things is that for the most part, even though the economy is strong, there's still this dichotomy between what the labor market actually looks like. Obviously, a lot of that has to do with immigration policy, et cetera. But the fact of the matter is that politically and sort of psychologically, to see monthly job gains closer to 0 than closer to 100,000 going forward will be something that, given the fact, and we also think that the tariff flow through has reasonably fully flowed through. And so, a moderate jobs environment and a lower inflation trajectory just continue to drive the ability to cut rates.
Let's finish by pushing that through the equity market, consumer discretionary. Does it turn things around?
We do think so. And again, our sector preferences, consumer discretionary, communication services, infotech. The subtext is all of them have large exposure to AI, but in this algorithmic trading world, what's good for the consumer is going to flow through and be good for AI names and, boost that sector.
Julian, you talked about the importance of $60 crude. Just flesh that out for us. Why is it so important to the stock market?
Well, it's the stability of the price. And look, I think one of the things that Trump has been very happy that he's been able to deliver going back to this first year is that visibly, in terms of the affordability crisis, there is not an affordability crisis at the pump anymore. Gas prices have continued to fall, and what we've seen is that has a tendency to bleed through to other areas. It has not yet, and it may not. I mean, if you think about what happened in the commodity markets yesterday, the surge in copper was anticipatory for this build-out that we're going to have in Venezuela. But the fact is that the consumer, among the prices that the consumer anchors on, the energy price is extremely important. And in that respect, sort of knowing that you're below $3 a gallon is very psychologically beneficial.
Is it consistent to have low oil prices and an outperforming energy sector?
It's a rough go to think about that in the long term. But again, and I think we've seen this over the entirety of this rally, there's a massive dispersion, the lowest correlations of really in many years among stocks. And I think when you look at the energy sector, you're going to see winners and losers based on where this is all going.
Do you see a reason to invest more in Latin America as a result of the Don Rowe doctrine that we keep hearing about?
Interesting question. Frankly, the reason that we think that the rest of the world, Latin America included, is more interesting is because we think you saw a very significant top in the dollar a year ago. And all else equal, again, over the long haul, what we started to see was portfolio rebalancing away from the U.S. dribs and drabs, slowly, and frankly, that's not going to accelerate given the fact that our view that the AI theme has further to run. But over the long term, if you believe, as we do, that you've made a significant top in the dollar, you want to diversify to the rest of the world.
The oil majors are jumping on this news, not so much crude energy. Before the weekend, as opposed to after the weekend, would you have a different view on potentially wanting to invest in the U.S. majors?
Again, if you look at 2025, one of the themes has been the Trump administration sort of influencing the selection of winners and losers on various themes, obviously steel, rare earths, et cetera. Clearly, there's an element of this happening now. We don't know what it looks like, but we do know that Donald Trump is a businessman, and the endorsement of Rodriguez, given her experience in the oil patch, really tells you that that's where the emphasis is going to be.
It does potentially help put a lid on oil prices, but when you think about AI, there's one issue of affordability that Americans are dealing with, and that's electricity prices. How are you thinking about that this year, given it is a midterm election year?
Well, it is no question that is the push-pull. It's been the push-pull the entire year. But again, all else equal, the president has shown an ability to influence events that moderate oil prices, and at some point that's likely to flow through to the rest of it. But again, the intent is because of the recognition of the importance of AI as a theme, both for the U.S. and on the U.S. corporate level.
Can we finish with a sentiment check? Year-end price target, 77.50. Been busy speaking to clients. When you talk to them, are they more excited about what can go right this year or more worried about what can go wrong?
I would say it's in balance, to be perfectly frank. What bothers us is that this is the first time in my memory, going back to when I was on the buy side, that there was no strategist on the street that had a price target below where the index level is. Thank you, Bloomberg, for compiling that information. And what we found that over the course of last year, when sentiment got tipped too far in one direction, you had pullbacks. And here we are at VIX 14. So to assume that it's clear sailing, for weeks on end is probably a faulty assumption.
Stay with us. More Bloomberg surveillance coming up after this. Investors looking for a fresh slate of economic data to kick off the new year. Sonal Desai, Franklin Templeton Fixed Income, writing, I maintain a constructive outlook for US growth. There is a lot of uncertainty, however. I see the balance skewed towards inflation risk, especially in the first part of 26. And I'll join just now for more. Sonal, good morning. It's good to see you.
Good morning. Nice to see you.
It's very nice to see you. Happy New Year. Let's talk about that source of inflation risk. What's the most prominent source of inflation risk for you and the team?
The fiscal impulse. So you were just talking about what we hope to see. But the reality is this week, we already know the big beautiful bill is going to hand out a lot of goodies across the board, whether we're talking about the consumer, whether we're talking about industry. All of these factors lead to inflation. And we haven't actually, something which comes on and then moves off the front page is the $2,000 rebate check. Remember that in the first 3 months of the Biden administration, we helicopter dropped $1,400 checks, and I've always maintained that was one of the principal sources of the inflation burst we saw, that massive fiscal splurge. If we get that splurge in H1, it results in consumer demand. And I know that there is a lot of concern and angst about the labor market. The labor market is a different labor market. I don't think you can read 30K jobs the same way you could read 30K jobs 2 years ago. That's supposed to be balance right now. So if you're above 30, the economy is kind of treading water.
Do you see companies potentially passing on more of these higher costs if the consumer is able to do it because they have more money in their pocket?
Yeah. I do actually. They're passing on the higher costs, but also genuine higher demand. The one thing which continues to flow through is the American consumers' desire to consume. And I'm very interested to know what the end of this Christmas season will look like. But looking at what we're hearing in real time, it looks like it's going to be a strong one.
Putting these two stories together in Washington, D.C. right now, the president is clearly putting a lid on oil prices going up when it looks what's happening in Venezuela. At the same time, they're going to potentially get more fiscal impulse ahead of the midterm election. Does the oil depression of a price help the potential stagflationary fears you have?
So it's not stagflation. I'm expecting growth of 2.75 to 3%, driven by that consumer demand, driven by the fact that we're getting private sector investment in this country between last year and this year. It's around $1 trillion. That's more than it's about as much Germany is going to do over 10 years. So when you stop and put that into perspective, you've got a lot of tailwinds coming in for growth this year. So it's not really stagflation that I'm talking about. I'm just saying that I don't expect major advances on inflation. Now, can oil be the game changer? I don't think so. I don't think in the near term. I think Venezuelan oil, that's a 2-3 year out story because, yeah, there's a sentiment driven, yes, there's going to be a lot more supply, but how much actual supply are you going to see in the near term? So
we talk about inflation as though it were a monolith, and inflation can be expressed through the market in many different ways. It can be a higher long end of the yield curve. You could see, for example, the dollar weaken substantially. You could see metals prices go up significantly. Which node do you think will transmit through markets most directly?
I think a little bit of all. So you're going to see a further steepening of the yield curve in my book because I think the Fed should not have cut up to 350, and if they actually go further than 350, I think it would be a substantial mistake, and we're going to see a significantly steeper yield curve. Because if we stop to think, the Fed has cut 175 basis points and 10-year yields are higher than they were before they started cutting, which means underlying the market's apparent sanguineness about everything that's going on, clearly there is some concern on the fiscal and the inflation. And in terms of the dollar, I'd say the dollar is a little bit mixed in terms of the G3. I think we're pretty close to fair value against the euro, actually. And I think we're massively overvalued
Can I jump in? Because you'll acknowledge the bulk of that move was in 24, not 25.
Yeah, absolutely.
In 25, they cut interest rates and bond yields on a 10-year maturity actually fell. They didn't rise. What's changed for 25 in the cutting cycle of last year compared to what we saw in 24?
Because I think this is the year you actually if you get the fiscal impulse that I'm talking about, those tax rebate checks, so the consumption demand, the tailwinds are stronger. I think in addition, on the non-AI hyperscaling front, we actually haven't seen that much investment last year, and I think we probably will this year. So I think there are lots of tailwinds to growth this year that we didn't actually have last year, and you had everything related to the tariff-related uncertainty, which really skewed one half of the year. So I think when Tariff Liberation Day was first announced, everyone was sure that meant a recession in the US. I didn't, but having just said.
Congratulations.
But it was, so I think we just start from a different spot.
So a steeper yield curve in and of itself isn't necessarily negative for the market. It can be actually really positive when it comes to financials. The absolute level of yiels does matter.
Yes.
What's the stopping out point for 10-year yields where suddenly risk assets lose their luster?
So I think, I think that fixed income markets have shown an ability to absorb all the way to 475 and above. Equity markets, it's a different question, and I'm not an equity person, so I'll duck that. But I'll just say that, do I see 10-year yields going back to those substantially above 450, close to 475 levels? Actually, I do. If you don't have the wild card, which is something which knocks the economy into a recession, and really, it's just not my baseline. If I look at the tailwinds coming from monetary and fiscal policy right now, it's very hard to argue that we're heading for a weakening of this economy.
Equity guys love to talk about bonds. You bond people can talk about equities. The spread in the last 30 minutes is three cuts. You're basically at zero for this year. And Julian Emanuel of Evercore, equity guy, is at 3 for this year.
No, and I think that's the difference. Because I think equity people do get concerned. Certainly within my own firm, my equity colleagues get very concerned when I say that, honestly, they shouldn't have cut last time. And I'm not sure they're going to cut at all this year.
Let's be really honest. Equity guys talk about bonds, and bond guys talk about equities all the time. They just preface it by saying, we don't cover that, but let me tell you. That is what happens every single time.
I agree. What can I say?
So that's good to see you. As always, thanks for dropping by.
Thank you so much.
Sonal Desai there at Franklin Templeton. Stay with us. More Bloomberg surveillance coming up after this. Hollenhorst of Citi's got things to say on the data and on that too. In our base case, the unemployment rate rises to 4.7% in the December jobs report, continuing its trend higher and keeping the Fed reducing policy interest rates. Andrew joins us now for more. Andrew, good morning.
Good morning.
Good to see you.
Happy New Year.
Yeah, Happy New Year to you too. That's not such a happy New Year for the labour market though. The drift towards 5 continues.
We think so, and I think that we're in the business of forecasting these things on a monthly basis. There's a lot of volatility. We have some residual seasonality in the data. All of those things kind of obscure what's going on. But if you just step back and look at what this labor market has done over the last 2 years, we've been trending higher in the unemployment rate. We've just been consistently trending higher in the unemployment rate. So we think that trend continues this year. We do think that can happen in the jobs report that we're going to get this week with the participation rate coming up a little bit. Maybe that's going to push the unemployment rate higher. But what I would really emphasize is that broad trend towards loosening in the job market.
Mike talked about the hawkish tilt as the FOMC rotates and you get the regional voters, the new ones coming on board for a year. What is the credible case to stay on hold? What is their case at the moment?
So I think it's all about how comfortable are you with the labor market, and then how much discomfort do you have about inflation, and then to some extent financial conditions also, because financial conditions are easy. They've been easy for some time. And then on inflation, and this is where I think people really differ, we're above target on inflation. If you listen to Chair Powell, he'll say 2.8% or so core PCE inflation, but go ahead and subtract about 50 basis points from that due to tariffs. You're down at 2.3%. So I think there's a core of more dovish Fed officials that are looking through that tariff inflation and are not that concerned about inflation. But there's a group that are still concerned about inflation. So it's going to be the jobs data that matter in terms of, are we becoming a little bit more uncomfortable with the job market, this very low hiring job market? And then on the inflation data, and that could take a number of months, but we have a clear slowing trend in shelter prices. I do think that some of those concerns about inflation will dissipate over the course of this year, but they may rise first before they dissipate later this year.
One thing that Richmond Fed President Tom Barkin talked about was that this is going to be clean data, and that he's looking forward to getting some clean data. How much do you actually think this data will be the first clean read since the government shut down? So
I think on the jobs report and on the unemployment rate, this is really important in terms of the interpretation. A lot of people looked at that November unemployment rate and said, yeah, 4.6%, but maybe it got boosted because of the government shutdown. So even if we hold steady at 4.6% on the unemployment rate in the data for December, I think people will look at that and say, well, that was a clean 4.6%. And we've heard different Fed officials differ in terms of how clean or not they think that number is. So yes, I do think that, especially on the inflation data, I think there are big questions about the inflation data during the shutdown period. But on the jobs data also, there are some lingering questions. This jobs report will help to resolve those.
And you think that it's going to resolve it in terms of possibly even getting a Fed rate cut by the end of this month? And I just wonder how far that will go to bolstering a labor market that's being affected by other issues outside of any kind of monetary policy.
Yeah, not very far, right? So that's you're cutting interest rates 25 basis points and doing it in this month versus doing it later this year. That's just not going to have a huge effect on the macroeconomy. But I think you're still watching the labor market because you're looking at three things. If the labor market is loosening, it's telling you maybe you're not really at neutral, maybe you need to cut a little bit further. It's telling you there's going to be less inflationary pressure because we don't have this wage pressure, we don't have a tight labor market. And it's also telling you that maybe I want to start thinking about insurance. This is not something we're really hearing from Fed officials now, but maybe I want to think about, do I need to be at least at the bottom of the range of neutral? Maybe I'm going to need to go below neutral because if you're actually getting to 5% unemployment. And I think it's a very obvious point, but one that's being missed a little bit in some of the rhetoric around this. The unemployment rate is moving higher gradually. It's good that it's a gradual move and not a sharp move, but if we just keep moving gradually higher, we will hit 5%, and you'll keep going north of 5%, and at some point we'll say, we really have an issue with unemployment in this country.
Andrew, when it comes to inflation, what about healthcare inflation, given the fact that subsidies are rising?
Yeah, so we have this really complex technical issue now with the way that these healthcare subsidies are going to change as we go into 2026. That could have some direct effect on the CPI data. We don't think it's going to have much of an effect on the PCE inflation data. But in terms of just consumer costs, right, this is a higher cost that consumers will be facing. But I don't think it will have a big effect on the reported numbers.
So when it comes to inflation, what is the biggest concern then in terms of policy? Because everyone will talk about tariffs, but this year is also healthcare. Do you think any of these will have an impact?
I think what I would be watching in the inflation data are two things. One is, do we see this continued gradual softening of services inflation? We're seeing it most clearly in shelter. We're not seeing it as clearly in non-shelter services. So that's one question. The other question is, I was mentioning earlier, Powell talking about this 50 basis points due to tariffs. Well, is that strength that you have in goods prices, is it really tariff related, or are there other factors that are playing into higher goods prices? Is that going to continue, or is that going to dissipate? I don't know if policy can do a lot to address those things. And when people talk about affordability, honestly, I think a lot of what they're talking about is the expense of buying a house, which has to do with mortgage rates, and that, well, the Fed cutting interest rates will bring that down.
And also, Andrew, things are just bloody expensive.
Everything's expensive.
Jim Bianco sounded so English then, didn't it? Jim Bianco did a great job of this over at Bianco Research.
Yeah.
The Fed talks about one-offs and one-time changes because they're focused on the change. The public is dealing with the price level.
That's right.
And where prices are is just ridiculous. Anyone trying to buy food or pay the energy bill, it is absolutely ridiculous. Do you think the Fed needs to reconcile the differences between how they look at inflation and how the public experiences it?
I think certainly in how they talk about that, it's very important to kind of get the rhetoric right around that, because it is true. I experienced that. You go to the store and you're just shocked at how much everything costs. And I'm an economist. I understand inflation. I understand price level. But I still have that emotional experience of going to the store and realizing how expensive everything is. So yes, the price level is higher. And I think that is something that should be communicated more clearly, is that the path forward, it's going to be difficult to bring that price level down, right? We're not trying to generate deflation. Now, what you would hope is that wages continue to grow, right? And we end up having real growth in real wage growth. And we are having some of that now, which is a healthy thing. But honestly, you need years of that for people to feel better about these prices.
Quick one to finish. The new Fed chair. Is his name Kevin?
I think there's a high probability that his name will be Kevin, and I think that's about all we can say right now.
Helpful. Andrew, thank you. Stay with us. More Bloomberg surveillance coming up after this. Let's talk about this market. Troy Gayeski of Future Standard writing, in an environment where public equity valuations are stretched and it's very difficult to find growth outside of mega cap tech, middle market private equity stands out as an oasis. Troy joins us now for more. Troy, good morning and Happy New Year.
Good morning, John.
Good to see you in the studio. Thanks for coming in, buddy. Thank you. Let's talk about setting the tone for markets worldwide, and in private markets for that matter. To what extent does the fate of one company, and I'm going to say it, OpenAI, that one company set the tone for the broader market?
Well, as we were discussing before, OpenAI has been at the cutting edge of obviously infrastructure for the complex, right? And that has driven competitive pressure for the hyperscalers, who are historically petrified of losing market share in various areas, to spend money at prodigious rates, right? The fact that 30, 40, 50, maybe even 60 basis points of contribution to nominal GDP will come this year. So they've been critically important in waking up the giants, so to speak. On a go-forward basis, though, the hyperscalers are going to drive more and more of the outcomes, we believe.
What I'm getting at really is the fate of the public market. How tied is it to what is happening in private markets and vice versa?
Yeah, so their private markets tend to have an advantage for funding early. As you know, if you look back, 15, 20 years, it was all about small scale funding and then eventually going public, and that allowed you to grow. As private equity and private credit has grown up, they've been the preferred sources of financing. And then prior to that, of course, in growth areas, you have venture capital. So private credit infrastructure has led the way in terms of financing these projects. And then now, of course, you have a little more circular funding coming, again, from the largest 5 companies in the world.
There is this question, though, and I think that just to build on what John is saying, OpenAI and their investment has really fueled a lot of other investment in infrastructure, in data centers, has propped up the valuations of it at a time when suddenly people are looking for more efficiency. At what point does that pose a significant risk on a credit perspective to private credit and infrastructure investment this year?
Well, so I think big picture, right, if you're looking at the ROICs that at least are modeled out in data centers, and to be fair, remember the demand for compute, not just in AI, but obviously almost more importantly in old school, SAS or other applications, continues to outstrip demand, right? So you have tremendous demand for the computational power of the storage, and you don't have enough supply yet. So trying to extrapolate in the near term that some struggle at OpenAI would lead to some circular backwash is hard. We could see 27 and 28. By then, if there's not an AI ROIC, it's going to get a little bit tricky in terms of forward CapEx budgets.
Do you think that data centers are a good place to keep investing in? Or do you think that there needs to be a catch-up trade with some of the energy sector as well from a private investment perspective?
So look, all the analysis our team does, and we're a much smaller player, roughly $2 billion in assets, is that forward demand, particularly in situations that are funded by hyperscalers, where you have that recurring revenue, that free cash flow, look very attractive. The comparison I always use is if you look at senior secured commercial real estate lending versus the senior part of the capital structure in data centers, you get an extra 50 to 70 basis points pickup in hospitality, for instance. However, once you move down into mezz and equity, given where we are in a real estate cycle, you arguably have more upside the next several years in the digital space.
But to Lisa's point, is there a mismatch potentially for the energy that is needed to run these data centers that could potentially hold the story back?
Well, it's a great point. So I think big picture, this is back to demand outstripping supply, right? So when we look at one of the risks to GDP growth this year, it's less about on the demand side and more about can you actually construct enough, right? Do you have enough copper? Do you have the political will? I mean, the other day, Bernie Sanders and Ron DeSantis agreeing on constraining, how often do you see that, right? So there are more challenges on the supply side, less challenges in the near term on the demand side. And so that tends to bode well for investments, at least over the short to intermediate term.
Do you think that's going to enforce discipline on these players and stop them from spending loads? I think Michael Semblis of JP Morgan Asset Management talked about this recently. I've got copper through 13K. The electricity needs that Lisa talked about, the social pushback as well, that so-called gating. How much of a disciplinary effect will that have on these spenders?
Well, as of now, given the size of the budgets, it looks like the spending side is set. Again, it's more on the supply side. So I wouldn't expect until 27, 28. Remember, the key factor here is when will the ROIC for AI really show up in the real economy? Not in search, not in Gemini, et cetera, but in the real economy. Everyone for the time being is willing to spend.
When you said the real economy, what do you mean? Just explain that.
Well, so one of our kind of small trades in our multi-strategy fund, for instance, is trying to find players in broader industries, medicine, chemicals, energy, infrastructure, et cetera, where you can actually use these tools to meaningfully produce or boost productivity growth. That's starting to show evidence, but it's unclear if it's enough to drive the continued growth of spending, right? And so what I'm talking about here is you think of a flatlining in spending, call it 27, 28. That will be fine for broader markets. We'll have a multiple correction, multiple compression, hyperscaler multiples will come down, but it'll be very, very challenging, if not catastrophic for hardware. So, when you step back, whether it's public markets or private markets, I think the key in your portfolio is to have enough exposure to the AI trend that it can move the needle, but not so much that it causes significant damage if it peters out.
We can turn to the debt markets. Just seen this headline cross on a Bloomberg terminal. Broadcom, 4-part debt offering coming from that company, Lisa, just crossed on a terminal moments ago.
Yeah, and I wonder how much of it's going to be a 50-year tranche, considering what we saw from some previous ones. It is interesting to see all the debt that is coming to market and the fact that it has been received so well. It has been in the public markets. Now following on to the private market financing, they do have a 30-year tranche. I don't see a 50-year tranche, but who's next, right? This isn't over.
It's a new story, isn't it? It's a new shift. There's a different character to all of this, and I think it started coming out of summer. We moved away from using cash flow, and we started to move to the debt story. I'm not talking about Broadcom. I'm talking about what's happening with the oracles of this world towards the end of last year.
Yeah, and it is a different proposition for the oracles of the world, which doesn't have profit. But when you have Google or Amazon it's a very different story. I think that it was Torsten Slok who said that in 2024, 7% of total investment grade issuance came from the tech sector. It was 14% last year, and it came just in a couple of months, all at once.
Amazing. Troy, do you miss talking about Bitcoin and public equities? Do you miss any of that?
Not really.
No.
You know?
Just asking.
And on that topic, if I may, to
just quickly,
swing back to private equity. So
of course, yeah. Why not?
Why not, right? So if you think of the AI, one of the nice things you can find are other sectors with tremendous growth. In healthcare, and it's not because of my engineering background, we're very excited about robotic surgery, infusion care. Not maybe as juicy as AI has been the last 2 to 3 years, but very good upside and limited downside.
Well done for squeezing in that extra trade. Troy, thank you. Troy Gayeski, a Future Standard.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.